I'm going to skip ahead a little bit here and start talking about the company using the map, because many of you are new to the company. And I think this kind of summarizes what we do. We are in the midstream energy business. Our primary business is to transport and store and process energy commodities for a fee. So we do it under contracts. We avoid or minimize commodity price exposure. And we have an appendix, in the appendix, a slide that kind of lays out our contract structure a little bit. We typically are doing this under long-term contracts with fixed fees. Much of those fees are not dependent even on whether the customer uses the capacity or not. So these are secure cash flows on a great midstream energy network. And just backing up a little bit to kind of a big picture here. For those of you who have been following the sector, you know that we've been going through some very dramatic changes in North American energy over the last few years. If you look at the time period from 2006 to 2012, we have in the United States reduced our oil imports by 40%. We have increased our domestic gas production by 30%, and those trends have continued. They continue to this day. That's a reversal of a trend dating back to the Arab oil embargo, where we're importing increasing amounts of our energy needs. We've seen growth in natural gas to the point that we are now certifying facilities that we're going to be importing LNG, and we're turning them around to export. Over 9 BCF on a, call it 70 BCF a day market, 70 billion cubic feet a day market, now looking to be exported from the United States. Those are very, very big moves. But what that means for a company like us and what that means for our sector is that all that investment that would have been happening overseas in the Middle East or in Northwest Europe or in West Africa or someplace, that investment is now happening in North America. Because as this stuff is being produced, it needs to get somewhere. It needs to get transported. It needs to get stored. It needs to get processed and handled. And that's presented an enormous opportunity for energy infrastructure companies like ours. So to put that, just kind of go business by business here, for our natural gas business unit, and that's shown here in several different colors, green and red and brown. That's just distinguishing between the different entities, and I'll get into the entities in a minute. You can see this is the biggest natural gas network in North America. It actually contains several businesses. What you see on the map really are interstate natural gas transmission systems. But we also have a significant gathering, processing, and intrastate pipeline business as well. And we move more natural gas than anybody else. The natural gas production that's growing right now is coming out of the Eagle Ford, and out of the Marcellus and Utica, and to some extent in the Rockies. And you can see our assets are very well positioned for the growth in that production. The other thing that's happening in the natural gas market is because we're producing so much of this stuff now, we're now in a position of exporting. So we have a couple of LNG facilities. These are under long-term contracts right now to import LNG. So we still are we're getting our demand charges, getting our reservation charges for the imports. But we're investing in EPB over $1 billion in a joint venture with Shell to convert this import facility into an export facility. And this is not just happening to us. This is happening all around the Gulf Coast, and there are projects on the West Coast and in Canada as well. If you were to roll the clock back to 2003 or 2004, again in a 60 to 70 BCF market, probably low to mid 60s at that point, we thought we were going to need to import 15 BCF of LNG. And so everybody busily went out and built all these facilities. Now we're looking at exporting, depending on who you believe, 9 to 11 BCF of LNG going the other direction. That creates opportunity for us in the LNG part of our business, but it also creates opportunities across this grid, because as we're moving more of that out, we're going to be increasing utilization of the transportation grid over time. And the time frame over which that's going to be happening is 2017 to, say, 2019. So a nice longer term. So we've had the shale production growth already. So the supply side's been growing. We've got a nice demand pull going on there. The other big development that we have is exports to Mexico and even exports to Canada. Believe it or not, we are now exporting gas into eastern Canada, and we're exporting as a country close to 2 BCF a day into Mexico. It varies. It's a little lower than that right now during the current season. And we are most of that. Knider Morgan, either off of our intrastate system or off of our El Paso natural gas system, we are about 1.7, 1.8 of that total movement. So substantial opportunity on the demand side, and that isn't even talking yet about power demand. As more electric generation switches over to natural gas, that's another demand pull on that network. So in this business unit, and I'll go through each of them, we have a $2.7 billion project backlog, and what I think is a nice opportunity to face some increased utilization from those supply and demand factors that we're seeing on our grid. Our second business unit that I'll talk about is our products pipeline. And in that group, we have refined products, and we also have natural gas liquids pipelines. And you see those here on the blue, serving refined products, serving the West Coast, and serving the Mid-Atlantic on our plantation system. And the NGL line you see here right now is in propane and EP service, serving the upper Midwest. We're actually reversing that line to move condensate into Canada, where it gets blended with the heavy oil and making that oil transportable. So we're reversing that line to bring condensate up there. So in this business, we are the largest refined products mover in the United States. Refined products volumes have been relatively flat. So that part of our business has been flat. We've just now started to see some uptick in year-over-year demand as the economy is recovering in the places that we serve. But on the NGL front and on the crude and condensate front, we're seeing tremendous growth opportunities. It's a little hard to see here on the map, but we actually took one of our natural gas pipelines, converted it to crude and condensate use to take product from the Eagle Ford up into the Houston Ship Channel. It cost us we had some new build in there. It cost us about $220 million. We have added on to that another $300+ million of additional laterals, supply laterals and delivery laterals, and $360 million worth of splitter projects, which is basically taking the condensate and breaking it down into component parts so they can fit into the refining complex in the Houston Ship Channel or get on a boat and go overseas where the market is stronger for it. Now, when we're doing these projects, we are not taking that commodity price risk. We're going to our customers. We're securing long-term commitments from them. Those commitments reserve capacity and give us a fixed amount of revenue, whether that capacity is used or not. But we have upside, particularly in a business like that, where we secured that original construction with a 50,000 barrel a day deal on a pipeline system that now has 300,000 barrels a day of capacity. So significant upside. As we're looking at the build-out that we're doing on that system alone, we're looking at EBITDA multiples that are under 6. Okay, so very, very good opportunities to build off of the infrastructure that we have. We're also the largest independent terminal operator in the United States. You see that on the circles and triangles that are shown here. It's split almost equally between bulk and liquids. On the liquid side, it's refined products, it's ethanol, it's crude to some extent. On the bulk side, it's things like petcoke and coal, our two biggest bulk energy commodities. And here, again, similar contract structure. We're getting paid for the space that people are using, whether they use it or not. So we get a certain minimum that's locked in, and then we get paid more to the extent there's additional throughput or additional ancillary services that are provided. So a good fixed revenue stream with some upside on it and a nice asset position. Really, we've got a huge position, the biggest, I think, independent oil and refined products terminal complex in the world is here in our Pasadena-Galena Park complex. We're increasing our capacity there to just under 40 million barrels of storage capacity. And also in Edmonton, building a significant position as well. The other big business is the CO2 business, and here, a little hard to see these light blue lines. It's really two businesses. We are producing CO2 and transporting it for use in enhanced oil recovery operations in West Texas. And so on that part of our business, we're getting paid like we get paid on our pipeline business. Third parties are securing the commodity from us or securing the space from us to move. And this has been a constrained resource. So it's been It's attracting a lot of new capital investment for us in the future. And then the other part of that business is enhanced oil recovery. So this is the business that's a little bit not like the others. We actually have some commodity price exposure here because what we're doing is we're taking some of our CO2, we're putting in the ground, we're pushing oil out. Now, we got into that business initially as an adjunct to our CO2 source and transportation business, but it's been a very lucrative and attractive place for us to put capital. And in those particular fields, we have a unique tool. We're not an E&P company. We're not going to go out and just compete and wildcat or just go out in the shales and try to compete with other people who are in that business. But CO2 is a unique and constrained resource, and it is the only thing that can free up oil from some of these fields in significant quantity. And so our enhanced oil recovery business is where we capture that value. And finally, our Trans Mountain pipeline system. This is the only crude pipeline that is serving the oil sands producers to the West Coast today. It's about a 300,000 barrel a day system. We just finished last year getting contracts to secure a tripling of the capacity of that system up to 890,000 barrels a day, 20-year contracts underwriting 93% of that volume, and the other 7% under a 15-year contract. So again, an example of how we do the transportation business in Knider Morgan. We secure the capacity under long-term contracts with our customers. Those arrangements underpin stable cash flows for our existing businesses, and you can see the various term lengths of our contracts, average term lengths in the appendix of the presentation, and we use those contracts to secure our economics on incremental capital investments. We're not speculating when we put this infrastructure investment in place.